Hey everybody, it's Rich from richonmoney.com, and today I'm here to talk to you about should I use a home equity line of credit, HELOC, to pay off my mortgage? And here's what people usually talk about. And the way this works, a home equity line of credit, essentially it's a line of credit against the equity in your house. And obviously you don't get to do this unless you have equity in your house. And what equity means, of course, is if you have a loan out on your house, let's say that your house is worth $100,000, there's debt in the house and there's equity. The $60,000 that you owe is debt, and the $40,000 that is sitting as value in the house is equity. If you have enough equity, you can borrow against that. And that's what you get to do with a HELOC. So I've been hearing a lot more recently, and even in the comments on one of my videos, hey, shouldn't you just use a HELOC to pay off your mortgage quickly? And that is a very interesting concept. What you have to realize when you use a HELOC to pay off your mortgage is that you're using a loan to pay off a loan. And so really you're just swapping one form of debt to pay off another form of debt. Is it a good idea to do, and why do people do it? So that's what we're here to talk about today. Well, first let me say how people tout it as being a good idea. What they say is the reason you should do this is sometimes the home equity line of credit can be a lower interest rate than what you have on your mortgage. And they also say that even if it's the same interest rate, there are sometimes reasons why it makes sense to use a HELOC to pay off your mortgage. Another reason they say it's a good idea is that you might have an interest-only option on your HELOC, and that it could end up in lower payments each month by tapping the interest-only option. Another reason people say it makes sense is this argument of a HELOC uses simple interest to calculate and a loan uses amortized interest. With amortized interest, you're paying a large bulk of the interest up front at the beginning of the loan. And with simple interest on a HELOC, you're sort of paying a daily interest rate that stays the same no matter if you're at the beginning or the end of the loan. And people say that the difference between that simple and amortized interest is big enough to make a difference, a huge difference that makes sense to pay it off with your HELOC. Here's what I'll say first. HELOCs are variable rate loans. If you bought right, you've got a fixed loan on your mortgage. So are you really going to switch from a fixed rate to a variable rate? Is that a good idea? Rates are at historic lows, and you could end up getting stuck with a higher rate in the future. Stick with your fixed rate. Do not do this crazy HELOC idea. And I hate to call it crazy, but that's what I think it is. Number two, HELOC interest is not tax deductible. Unfortunately, not everybody gets to be able to take advantage of these tax deductions because the standard deduction is so high now, and you have to exceed that to be able to take advantage of it. And so it's difficult, but you are swapping a loan that can be deducted for a loan that can't be deducted if you go with the HELOC route. So something to consider. Here's another thing to consider. A home equity line of credit can be frozen. So maybe you're using this home equity line of credit and the economy gets shaky and the bank will be like, nope, boom, we're stopping your home equity line of credit. If you were depending on it for continuing to pay off your loan or for whatever other reason, the bank can just say, not anymore, we're done. They did that in 2008 in many, many locations. So there's something to consider. Another reason that this isn't a great idea, and it was touted as a benefit earlier, was the interest-only idea. Yes, you can pay interest only, but that only lasts for a certain amount of time, either 5 or 10 years. Then it reverts to typically a 20-year principal and interest amortized loan for the rest of the term, which is going to be higher. So all in all this hype around HELOCs, home equity line of credits, I'm not sure I like this idea of using a loan to pay off a loan. Because really, what is that? Really, what is a loan to pay off a loan? Well, it's not a payoff, it's a refinance. You still have a loan, but you have a different loan. You have an inferior type of loan that is non-deductible and is variable. Really, now you no longer have a mortgage, you just have a shitty HELOC. I don't like it. So let's consider a couple of other things. What about using a HELOC just to get rid of PMI? Just to get up to the 20% threshold you need to get rid of private mortgage insurance, because that's really important. A lot of people are paying extra money because they don't have a 20% down payment. They had less than 20%. Well, what if you just use PMI to reach that 20%? How much money would you save and would it be worth it? Well, I would argue still don't use it. You could do the math and you can consider if you want to do that or not. And I would argue that it's not as bad as paying your whole loan off with a HELOC, but for all the same reasons we've already listed here, I would say still don't do it. You're just swapping one form of debt for another form of debt. Ooh, here's an idea though. What about debt consolidation with a HELOC? Now that's a great idea, right? Oh boy, oh boy. Here's the deal with debt consolidation with a HELOC, and this is craziness. You pay off your high interest like credit cards and all this other, horrible mistakes you made with your money. There's higher interest. You pay it off with your lower interest HELOC. Why is this a horrible idea? Simple. Secured versus non-secured debt. What does that mean? The debt that you screwed up on, all these credit cards and all that crap, it is non-secured debt. If you just don't pay it, then it goes as a big black mark on your credit score. But once you put it on your HELOC, and then you decide not to pay it in the future, like you lose a job or become disabled, then instead of it just going on your credit report as a black mark, now they take your house to pay for it. So essentially you've let it go from non-secured debt to secured debt against your house. Bad idea. So there are better ways to pay your mortgage off early, and I've made videos about it. I've made a video about the 5 best ways to pay your mortgage off fast. Make sure you watch that video. If this today was helpful, please hit the like button. Make sure that you subscribe to this stuff, subscribe to Rich on Money, and also hit the bell so you get notifications when I made a new video. I'm going to make lots of new good videos. And leave a comment. What do you think about the HELOC debate? I think it's crap. I want to hear your opinion. This is Rich on Money, signing off.